Taking on an investment as a creator can seem a very daunting task, but there's actually just a spider web of different decisions that you need to make as a creator when you're trying to decide on the type of investment you're going to take on and where you're going to invest in. So, without further ado, just jumping straight into what that web looks like. It is a somewhat of a complex eyesore of a visual, but I promise you by the end of this video, it'll make all the sense in the world and it will help you make a decision whether you're ready or not to take on an investment from the outside of your organization, specifically maybe just you, if you're an individual creator. So the way to think about it, I try to centralize the themes around the questions that you will face as a creator when it comes to making this decision about the investment around these four. Why would you take on the investment? What kind of investment are you going to take on? How you're going to essentially, go about procuring it, what kind of basically source you're going to use, and then which of the levers you're going to use to kind of like make sure that there's an ROI on that investment for the individuals who are partnering with you. So jumping straight into it, you can think of the whys behind the investment in kind of like these rough three buckets, right? It can be just an opportunity for you to go and essentially expand your opportunities to monetize, right? To expand your revenue. A great opportunity there can be developing new product lines, maybe investing into additional type of businesses you want to open, expanding a team. It might be the case that in order for you to do something like this, you kind of need to balance the both, and you need to hire an editor, hire a thumbnail designer, hire someone to help you write the scripts for your videos as you're now starting to share the time on additional monetization opportunities as you expand the revenue. So it's not like mutually exclusive, and none of them really are. It's just complementary in how you want to balance between the two, or do you want to just focus on the one? And then obviously there might be just an opportunity for you to take off some chips off the table because you already grew big enough of a business, it's independent enough where you can take on an investment, potentially leverage their expertise, their experience, their connections, but then take some of that money and put it in a bank account for the rainy day just in case you're not sure what the future holds. Or maybe you have some big live event happening, like you're buying a house, having a couple of kids, and so on and so forth. The what of your investment decision really circulates around how broad of an investment impact would you want to have on your personal organization. It can be a very holistic investment, meaning the person who invests with you invests pretty much into you as a creator, but also into pretty much anything that you touch, maybe outside of, I don't know, public speaking engagements when you're just doing it on your own, but anything that represents you as a creator, whether it's new monetization routes, new products that you release, maybe it's additional deals and certain number of revenue that you generate from AdSense, investment funds, and things of that nature, creator funds, sorry. You will essentially go and take on the partnership that someone's going to own the percentage share of all of those, right? Potential revenue streams. Again, it will require very likely for you to ask for a higher amount because you give up more revenue across the board. But again, this is absolutely possible. And company like Slow Ventures, that's exactly what they do. They like to invest into creator across the board, that everything that they touch outside of their own personal projects, not as a creator, but more as an individual like a Joe Doe. You can do a business investment. Essentially, you just want them to step in and fund a particular business venture. You're starting a physical product, you're starting a consulting service, and you really want someone to help you kind of like cash bootstrap you at the very beginning to hire maybe a few folks, buy the inventory, and so on and so forth. And then it can be a very specific project investment. You might already have a creator brand, you might already have a business, but within that business, say you always sold digital products and now you want to venture out into physical product, but it costs like $1 million for you to acquire and store X number of inventory to support the potential demand. And you can partner and strike a deal specifically for that project, for that specific portion of your revenue streams without giving up necessarily, say, equity in the entire company or even yourself as a creator. So again, a few decisions, and you can potentially flex in between those, and you can potentially take on multiple different investors, maybe one investor really at the holistic level, one investor at the business level, and one investor at the very specific project level. A little bit complex, but absolutely doable. From the perspective of how you're going to go about it, and we're going to talk in a couple of visuals about specifics between the three, you can kind of like go several different routes. You can go the private investment, which includes private equity, which includes venture capital. You can go crowdfunding, Indiegogos of the world, Kickstarters of the world, or maybe even your own type of website that you run to hope in hopes of like, gathering some additional crowdfunding from your fans, or a loan, right? You just take on a standard loan, whether it's a private loan issuing entity, whether it's a bank, essentially taking on that investment. We'll talk about difference and specific considerations you have to keep in mind. And finally, which lever are you going to pull to help ensure that there's a positive ROI on this entire investment? And here it's important to kind of like differentiate between profitability. Maybe whatever project you take on will start generating enough of profitability so you're going to have those like free cash flows, essentially just the money that comes in the bank and doesn't have any costs associated with which you need to go assign them to. You can decide to put that money obviously in your pocket, but you can also decide to go and use that as a vehicle to share the return with your investor or say cover loan payments. There's a growth potential, right? So maybe you don't anticipate the cash immediately. You don't anticipate any kind of like major liquidity event, right? Like meaning you're not going to extract the cash out of that project immediately. It's going to take some time, but there's a growth and the scale to which, say, venture capitalists will be attracted because yes, they're going to invest $1 million with you right now, but 5-7 years later, that $1 million might turn into 10 or 20, right? For them, it can be a very attractive proposition, and it's your other lever to potentially push and tease. And then longevity. It can be that, hey, there's not going to be like 10x within the short span of like 5 years. There's not going to be immediate cash flow infusion that you're going to be able to distribute across all of your investors. But you're going to create a very sustainable creator brand or a brand around yourself as a creator, maybe like some physical product or some consulting service. And it's going to continuously yield revenue year in and year out for the next 15 years. That can be a very attractive asset as well for pension funds, for different companies that want that long-term investment, that they don't necessarily try to strive and cash out in the next 5 years. They want something that they can put the money in and kind of like really count on it being there 15 years from now. That's an attractive lever. And again, looking kind of like at this visuals, right? I always have to precaution that there's layers under each one of those sections, but I wanted to start with that specific web to just help you understand that there are a lot of intertwining decisions and specific events that might trigger each one individual decision making point. But as long as you kind of like decide, okay, I know exactly why I'm raising the capital or trying to attract an investment. I know exactly where I would want to invest it and how much of potential equity or cash flow I want to give up. I know specifically about the type of investment I prefer, or say I know exactly how I'm going to generate the revenue. Those bits and pieces as they flow in will actually help you navigate and like dictate your direction and which kind of like type of investment for how long, how big of an investment you're going to take on. So it's not really that complex. Their complexity comes in usually with the tools, with the terms, with the legalities of things, the percentages, but just in the grand scheme of things, as you're trying to make that decision, as long as you know the answers to these questions, you're already in the great shape in order for you to determine the next step of actually taking on the investment. And that's where I want to dive into a couple of specific things just to call out and help you in your decision making. One, we're going to, decipher, reject a myth, I guess, myth bust a little bit around the complexity of the decision, whether investors needs to be super sophisticated about it or like differentiated compared to maybe your traditional investments into other businesses. We're going to talk specifically about a few types of investments and how to think of them. And we're going to talk about a few red flags that you have to pay attention to. Let's start with understanding kind of like within the investment web. One of the arguments that I've heard is that some of these investors might need a lot more education to kind of like really be efficient. True to some extent. There are certain investors out there who really understand a specific industry, manufacturing, supply chain, digital investment, software as a service companies, right? Things of that nature. There are specialty funds, absolutely. But if we kind of like zoom out and just talk about what do the investors try to do, right? From the traditional entrepreneur perspective, usually entrepreneurs identify a problem, they develop a product, say they figured out that there's a very specific gizmo that can address a certain need within a certain manufacturing cycle that usually breaks, but this is a high quality gizmo that's going to help that manufacturing not to break, as a very rough example. Then they try to find that first client, usually friends and family, companies they used to work for, things of that nature. They find someone they go and they sell it to. Okay, now we have the first client. We start now building the company around it, find the second, third client, hire people to support it, to procure it, do all this fun stuff to actually create an organization. And then at some point they start realizing, okay, I need scale, so I need to look for the distribution. The interesting part is that for the creator, it's not that different in the sense that the two steps shift between the distribution and the product. But with the creator, usually you also identify a problem. You identify the problem in the sense of like you think that there's not the type of content you want to watch out there. So you go and you create one and you become all of a sudden kind of like a go-to person within that specific industry. you start actually generating distribution right then and there, because all that audience that comes in and kind of like enjoys your content, now your distribution channel, then one or two of them start trying to buy something from you. Maybe you sold a digital product, a physical product, whatever you came up with. Your first client, your second client, all of a sudden, okay, now we get complex enough. We have enough of revenue. We need to have a company, taxes, all that fun again, exciting stuff. And then you kind of like start developing more and more products, right? From the conceptual zoom out perspective, very similar things. So whenever you start like working with investors, sometimes, unfortunately, I've seen investors try to like make it seem more complex, because all of a sudden that becomes more valuable for them to participate, right? Almost like they're trying to boost their value, like, oh, this is so complex and I'm such a, trying trying not to be very respectful. I'm this knight in the shining armor riding into this situation and trying to save you. Not really. Like, the only difference is that you will carry a lot more potential expertise about actual niche that you're creating the content for. They will know a little bit better about the investment vehicles. But in terms of like finding common ground, it's not that complex, as long as, again, coming back to the visual, you understand that you fronted the distribution before you actually establish maybe a series of products that you're selling. With traditional VCs in the past, they would find someone who first developed the product and then they help them invest to the point where the product is good and they find the distribution. That's it. That's all the difference. So whenever someone tries to claim that it's a lot more complex than that, be careful. And we'll talk about more of the red flags in a second. Now, the other important point that I want to make sure you understand, and I'm specifically focusing on these two plus the red flags, because I've covered some of the other points about like the product development, how to decide the kind of product you want to invest in, how to decide how much of an investment you want to take on. I made specific content around that. Let me know if you're curious in the comment section below. I'll share and remind you the links, but there's plenty of that stuff on my channel. This specifically, I haven't seen many people talk about, but I would like you to understand it, because there's a lot of this terminology about like private equity, venture capital. What does it mean? If you boil it down real quick, there's private capital category. I call it private capital because actually private equity and venture capital usually represents the same private capital investment, just a little bit of different stages, right? Think about it this way. Someone has cash, and it can be an individual, it can be a family, so they call like family offices. It can be an institution, say a pension fund, a specific organization that's cash rich. It can be government size fund, right? Like Saudi Arabia, Norway, they have their own kind of like government funds and like trillions of dollars that they invest across different companies to kind of like help fund their own governmental projects. All of it boils down to the fact that it's like private capital entering the environment. And the difference really between venture capital and the private equity comes down to this visual that I'm going to talk about in a second. Specifically, what I'm trying to do here is help you understand that there's a cost to that capital that you're raising, and there's a degree of control that you give up or retain depending on the kind of investment you take on. And starting with like, let's do a lower left corner. Venture capital is a good example of the cost of capital itself technically is not that high, in the sense that you are going to give up percentage of your equity, right, within the company, because that's what usually venture capital is interested in. And they will help you, and they will be kind of like your guiding star. They will help you with their expertise. They'll hopefully introduce you to some other folks who are experts in certain areas, but they're not necessarily interested in like running your company day to day. So you're going to have a lot more control with the venture capital investment compared to some of the other types of investments, as long as you are on the same page. And it's important to be on the same page with your venture capital investor, which again, one of those red flags we're going to talk about. But once you are on the same page, they're going to let you kind of like do your thing, because they're very likely invested a little bit across 100 plus companies. So they don't necessarily even have a capacity to go and babysit every single investment that they made. But again, they want to make sure you guys are aligned and decisions that you make are in alignment with those pre-agreed upon terms that you have in place. Well, like private equity, another type of private capital, right? In this case is a little bit different in the sense that private equity companies usually don't deal with the younger stage startups or younger stage companies. What they're usually interested in is raising fund, creating that fund as a way to kind of like pool a bunch of different investments, and they usually take majority stake in those investments. Meaning, where venture capitalists might be interested in just 10% stake in your company, so they'll take 10% of your equity. Private equity would want to probably get at least 51, right? They want to be in control. They want to influence who manages the business, who they hire to kind of like run it as a CEO, what kind of teams are kind of like, created around that business. They want to be very heavy-handed in every single decision. And in many cases, private equity funds are actually interested in full buyout. They basically want to see the actual initial founder of the company gone, right? Like, hey, here's your check. go enjoy your yacht or your island, however big that checker is and whatever you can afford and spend your money on. From private equity perspective, cost of capital because of this is a little bit higher because you actually give up a lot more from the equity standpoint. And also private equity likes to use leverage, meaning they like to raise funds on the loan side. So because of this, they actually can go and create an additional expense for your business in the sense of interest payments that you now have to pay. Like when you buy a house and you pay a mortgage and there's a monthly payment to service that loan. Similarly, as a company, they can raise the funds, invest into your company, but then you have to service that loan and make those payments. But you also give up the degrees of control, which is an important consideration compared to you taking out the loan, right? Like you can go and take out the loan on your own and you're going to retain a lot more control because bank say that you took the loan out of, they're interested in making sure you have a healthy company. They're interested to make sure you don't make stupid decisions with that investment. But once they understand, once they know the collateral is there, that they can go and claw back the money in case some like the project fails or something else happens. They don't want to manage your business day to day. They don't have time. They don't have capacity. They're really good at loaning out the money and deciding who they should give out the loan to. They have zero interest in managing your business or even opining on where you're going, what you're doing. They're absolutely fine. And interestingly enough, private equity actually uses a lot of the same banks to raise the funds. But for them, it's kind of like the trade off is you as an individual or a business, small business like a creator run business, you taking out a loan will very likely cost you more because of the interest payments and because you're kind of like less trusted entity versus a private equity who uses the same sources. They'll get a better interest rate because they probably raised millions and millions of dollars from the same bank and have good relationship and bank trusts them. But then although the interest rates are less, private equity will own the majority of your company, so you're going to give up more of a control. That's why kind of like the difference between the two, although both can leverage the loan infrastructure to support it. And just to throw completely a differentiating factor out there to just kind of like reset you, because you might be very familiar with Kickstarters, Indiegogos of the world. That's where like crowdfunding is pretty good in the sense that you retain a lot more degrees of control. You pretty much own everything. Like you don't own crowdfunded platform, anything really. You just want to make sure you deliver on the product and it's not a fraud, but no one's going to come and tell you how to run your company. In the same way, the cost of capital is pretty low because you don't give out the equity, you don't have any interest payments, you just kind of like go and invest the money into that specific project and hopefully achieve all the milestones that you're committed to, right? Don't get me started on the projects that do not deliver, have $2,000 story at some point to tell you in the future. But that's basically the idea. Hopefully it makes sense. I wanted to make sure I cover this portion before we talk about the red flags, because now you hopefully understand the difference. A lot of people kind of like scared away from the term like private equity, or they overthink about the venture capital. At the end of the day, just think about that cost of capital to degrees of control, and it's going to help you reset. Because then within each group, like I should probably put asterisks on all of these, because within that group, some loans are better than the other because of the covenants and different terms that they're associated with. Ignore it. Let me know if you want to discuss it more. Feel free to reach out. I can always explain to you. Private equity companies come in different flavors. Some of them like to invest much earlier. Some of them like to invest much later. Some of them, excuse me, like to buy from other private equity companies, the companies that already been invested into. Again, multiple different structures. And even for the VCs, there are different VCs and different degrees to which they want to get involved in the business. So again, people try to differentiate, people try to create like bespoke solution within the investment world. So you always have different degrees, but you will never be wrong with starting at least trying to map them on that quadrant and understand kind of like how much of a control do you give out versus how much of a cost you're going to be associated with using that as an investment pool. And once you're there, you can start again looking back at your web and kind of like comparing, does it match what I need to do and how I want to invest, how I want to bring the ROI. And it will again mature your decision much more than you just guessing, hey, is it good to take $1 million check from this company versus the other company? And finally, to wrap this up, I do want to talk about a few red flags that you should be considerate when you're trying to decide on who you're taking the investment from. So I nailed down to 5, tried to kind of like keep it nice and short for the video to let you out before it becomes like an hour-long video. But there's a lot more that we can discuss, so feel free to always reach out and I can kind of like help you navigate some of those. But the idea is, first and foremost, the one that I always look out for is image and likeness, right? You all know, you've heard horror stories about some people trying to do a brand deal, and there's a term about inheriting the image and likeness, right? Like, I think people got pretty good about like catching that, so no worries there. But in the investment world, I actually still see it. I still hear stories. I still hear some companies like to adopt that because if they take a certain percentage of the investment of the business, they might consider your image and likeness as part of that business investment. So you have to be very clear about it. And unless you're like faceless channel, unless this is something you're actually interested in as an individual and you're like, hey, I'm not really going to use it. I'm a faceless channel. I have this image and likeness. They can go use AI tool in the future, replace me with AI tool, or hire a different voice actor and I'm going to be good. Sure, go for it. Like, no judgment. But if you're an individual creator and your image and likeness is your name in your face and you want to do other things with that name in the face, I would say immediately no, right? Like that's one of those things that try to avoid because some of the people might try to be predatory because they're thinking, oh, in the future there's going to be AI tools and I'll be able to scan that individual and just recreate an avatar and it will look like that creator creates content. I'm just going to plow video after video through that. And that's how they're going to make money. There's going to be investment companies out there with that kind of investment thesis. So be careful. Like I would say, you see that, reject it unless it's really something you're interested in doing, and then ask for a lot more money because of the fact that you're giving up the actual persona behind that creator brand. Signing any kind of paperwork besides NDA too early. NDA, non-disclosure agreement, absolutely fine. In some cases, some companies are interested in like signing NDA to make sure they can very freely talk with you about like sources of an investment, who is investing in their fund, what their interest is, things of that nature. They'll show you some documentation, some prospecting documentation. Maybe they don't want everyone else to see it. Sure, reasonable enough. Just make sure NDA is not like 10 pages long because it's always a flag. But if it's like 1 to 2 page NDA and you have an attorney and they reviewed it, it's fine, good. Anything else, I would be cautious because people might try to lock you into exclusivity. They might try to look at the first look offer, things of that nature. If you're just evaluating the relationship with that investment fund, VC, individual, there's no need for you to sign a ton of paperwork. All of the paperwork should be signed at the point when all the terms are agreed upon, you understand what you're doing, and now you're kind of like working through all the exciting parts of actually raising funds, which is generating a bunch of paperwork. Until then, none is needed. If people try to get you sign anything besides NDA, red flag, I would be very careful. Outlandish valuation sometimes actually tied to the prior point, and I'll explain the ties, but make sure when you say understand that your business based on your revenue, based on value maybe of some of the other businesses, say you think that your creator brand is worth $3 million. If someone shows up and tries to say like, oh no, you're absolutely wrong, your business is like $50 million, let me give you based on the valuation of 50, no, it's 100, it's actually a red flag, primarily for two reasons. One, no venture capitalist or like private equity company, any investor would want to invest at a higher valuation than it actually is. Primarily because when they get the percentage, they get a percentage share of the company based on the valuation. So if they come and they tell you, no, your business worth more, we should invest based on that, there's a risk that they're kind of like negotiating against themselves. So I'll be cautious and ask, like, what's their motivation? Why would they ask? The other reason, and this is a more prevalent one, is that they actually trying to discourage you from working with any other investment fund or any other potential competing interests, say another private equity company that's trying to invest in you. And how they do it is because they promise and they say, oh my god, like we think you're worth this much, we're gonna strike all the paperwork based on this. The problem is, and we're seeing my full face on this, the problem on this is that they do that specifically for the competition because they don't want you, they want to offer you this large amount and want you to ignore everyone else and just work with them. Potentially, coming back to the prior point, they might ask you to sign something early to lock you in. And then they're going to shave off that valuation. They'll be like, oh, but we actually did some analysis and we realized we overstated it. And although we promised you 100 million valuation, we think it's actually 20. Oh, but by the way, we'll look at something else and there's a lot of risk. It's actually 10. Oh, but by the way, we also look at this and this and this and it's actually 5. Right? And all of a sudden you're back at a more reasonable valuation, but they got rid of all the competition by offering you a ton at the very beginning, a higher valuation at the very beginning. So it's always a red flag. It's unprofessional. There are funds that still do that. Again, there is a reason why private equity and venture can sometimes get bad rep. It's because of people like that. So always be cautious. If someone promises you something or offers you something based on a much higher valuation or overthinks about your business, they might be doing it on purpose and it's not because they're trying to do better by you. So keep that in mind. Lack of detailed questions, lack of transparency, I kind of like cover them both at the same time. Investors, especially venture capital, especially private equity, have theses and memorandums basically for what kind of investment they're going to make. Because of this, they will usually have very specific questions they need to understand answers to before they make an investment, because they have investment committees that they have to respond to and say, like, hey, here is a great investment and here is why and here's what we discovered about them. They need to gather a ton of information. So it means the questions need to be very specific. If you're talking to the investor and they're like, oh no, I need to know, you're great, I watch your content all the time, you're worth this, I'm going to cut you the check, I would be cautious. Once in a blue moon, maybe it's a great fan and they're really interested in, but to me, if they don't ask specific questions, they either not taking it seriously enough and they're not really interested in investing. They're just talking to you for the sake of talking, to say maybe to someone else, like, oh, I'm talking to this creator, and that's their motivation. But also the lack of the specific questions will introduce potential for misalignment. If they don't understand, like, hey, where you want to be, or you want to be in physical products. Actually, our fund, we on purpose never touch companies with physical products because we want to deal with the management of inventories and all that stuff, and like whatever returns, refunds, all that stuff. We just stick to businesses with digital goods, and it's good. Then you know, like, hey, this is not the right investor for me. I need to find someone who specializes more in physical goods, right? Like, those are the kind of examples of things that need to be aligned way before. Back to my point about when I was talking on the investment web, you want to make sure you're aligned with your investor and the kind of goals you're trying to pursue and the kind of investments you want to use then to grow what kind of parts of your business, and they should be aligned to that. And if you guys align to it, you're in great shape. If they don't ask those questions, again, they're either not serious, there's some other alternative motivations for them. So I would be cautious. People don't want to just give up money, right? Especially investment companies. They're responsible to generate return on that investment. So they will ask a ton of questions. And the more questions, usually, the better up until a certain point. Again, topic maybe for another day. And the transparency, you want to understand, again, general portfolio, what kind of things that they do, what their prior experience. They should be comfortable introducing you to some of the other investment funds. Again, they usually put all of the names of the companies on the website, but they should be open to introduce you to another company that they've invested in, to be like, hey, we're venture capitalists, we invest in these companies, they always have a positive feedback. Hey, can I talk to some of them? Sure. Here's the contact information. Go talk to some of these founders. They'll tell you how amazing it is to work with us. There should be a lot of transparency, because again, taking on an investment is like creates actually a very long-term relationship. It's almost like a marriage, right? I like to compare frequently this to a marriage, because you want to understand what you're walking into. Are you aligned on the goals? Are you both interested in the kids, right? In the personal side, are you both interested in a certain type of investment? Are you interested in staying in this country? Are you interested in growing in this industry, right? Like, it's very similar. The kind of questions you would ask your partner, potential long-term partner, are the same themes of questions that should be surfaced and aligned on, and very transparently with the investor. Because again, traditional investor will probably be there next to you side by side, owning a portion of your company for at least the next 3 to 5 years, if not longer. So you really want to make sure you're on the same page when it comes to creating this relationship. So those are the kind of like five, right, red flags that I would pay attention. Pay attention to anyone who's trying to claim image and likeness and is something you're interested in. Don't sign any paperwork too early while you're still evaluating things. Be careful about those who are trying to attract your attention just by offering outlandish and unrealistic valuations. And always ensure that people and you ask each other very clear, specific questions. And also, there's a lot of transparency about potential partnership and how it's going to look like in the future. Those are important things. There are plenty of other red flags. I can always talk about them. It's something of interest. The last thing I'll just say, coming all the way back and kind of like bringing back that investment web, right? Just think about those things, right? Like, think about why you're attracting the investment. How are you planning to invest it specifically? You need to be very specific in how you're going to invest. Again, how and what kind of investment do you prefer to kind of like get introduced to, based on that, like, cost of the capital and amount of control you're going to give up? Think about that. And then just think about, we didn't talk too much about it here, but I have, again, content on this in the other videos. Think about how you're going to return ROI on this, because again, that's part of that transparency and alignment. You want to make sure that there's some calculation behind it to say, like, hey, you're going to cut me a check for $3 million. This is roughly the kind of projects I'm going to invest in. Based on our early estimation, one of these projects is going to pop and generate $10 million in revenue. So that's going to give us the valuation to give you ROI back. And that's the kind of information the investor needs to go pass it on, whether it's a bank to justify the loan, to make sure, hey, yes, this brand can actually make money to pay us back on the loan, whether it's a private equity company because they're going to invest a bunch and they need to know that there's a predictable cash flow and they're going to generate the revenue back for their investors, their limited partners. Same for the VCs. They want to know that, hey, I'm going to invest, I'm going to give this money, they're going to build these businesses, I'm going to get some of that money maybe in form of cash, some of that in form of just return at a liquidity event where we're going to sell the brand or something of that nature. And then I'm going to bring money back to my limited partner, right? The people who actually cutting the check for those investors. So there's a lot. That's why it's called investment web. But hopefully now, compared to the beginning of this video, you're a lot more familiar and a lot more comfortable with understanding all of these terms and kind of like how to think through this. Again, people like to overcomplicate these things for a reason. It's not that complex. And because I darted through a bunch of these things in like almost 30 minutes, so it's still very quick for the amount of information I dumped on you, feel free to reach out. I talk to creators about this all the time. I love doing it. I'm not charging for it, not selling you any courses. It's just something I do because there are opportunities, hopefully for us, based on this information, to do something more long term. But for the advice, I can always spend an hour and talk to you about this, right? So feel free to reach out. Same for the investors. If you're deciding on what kind of creator to invest in, always love talking, vice versa, about the investment side of these things. Otherwise, I'll see you next Saturday. Peace.